Hey, everybody, and welcome back. Brandon here. And today I've got Rachel and Jeff on the line. I'm excited about them. I was just talking with them before we hopped on here, and they actually taught me a few things that I'm excited to share with you guys today. And this was in an area that I actually thought that I had done because I've done a lot of business in the area. But Jeff Nabers, he's the founder and CEO of the Nabors Group, a leading self-directed IRA and solo 401k provider. Jeff brought the solo 401k to the market in 2006, predicted the 2008 financial crisis, and launched the world's first Bitcoin IRA in 2013. He founded one of the first crypto hedge funds in 2017 and continues to follow his passion for alternative investments. And he's got who I assume is his wife, Rachel Nabers, here. Rachel helps investors, capital raisers, and accountants and financial advisors tap into self-directed IRAs and 401k solo plans to better reach their goals. Rachel, Jeff, welcome to the show. It's great to have you guys.
Thanks for having us.
Yeah.
We also speak at the same time.
Oh, hey, y'all got like the telepathic communication thing going. That's how we know you're married.
Yeah. It's on sometimes it works, sometimes it doesn't.
Awesome. Well, I'm newly married, so I'll probably learn a thing or two for you guys. For those of our audience that don't know y'all, maybe give us like a brief background. I know we kind of summed it up there, but tell the audience a little bit more about yourselves and kind of how you got into what you're doing today.
Yeah, so I got my start working for a mortgage bank and kind of spun off my own mortgage company when I was living out in Myrtle Beach, South Carolina. This was kind of during the first dropping of interest rates, refi craze, and I started working with real estate investors and learned a lot from my clients. And something happened kind of repetitively where I'd help a client buy a property, help them buy another property, line up all the financing and everything. And then they would go, Jeff, I'm tapped out. I got to wait till, my next property sells or I get some source of liquidity, and then I'll be back. And then I would look back at their loan application form and be like, well, what about all this money in this retirement account? And I had a couple of clients say, Jeff, if you can figure out how to buy real estate with that money, then I'll do it. But I'm pretty sure it's all locked away. So kind of created like a little weekend research project. And I was like, it's Friday, come Monday, I'll have this all figured out. Right. So like weeks and weeks and months later, I realized there's this whole kind of like deep rabbit hole, but like, yes, you can do it. And I started out just telling people to go to like a self-directed IRA custodian. They'd come back to me and end up mad about the whole experience because it really didn't work out the way they had hoped. And ultimately we started working with some attorneys and I'm flying all over the country back before there was webinars, just to figure out like, how can you do a real estate deal as simply and directly as you're used to doing it, but use retirement funds. And that's what led to us pioneering what's now known as the checkbook IRA, as well as the solo 401k. Rachel came on board about a decade later.
Yeah, I was supporting 7- and 8-figure entrepreneurs, helping them run their business more effectively. I met Jeff. I fell in love with him. I said, oh, I want to come and live with you and work with you and maybe help him in the same way. And after I fell in love with Jeff, I also fell in love with finance. And there was this incredible puzzle of trying to help these high earner entrepreneurs not overpay in taxes and have a better strategy. And Jeff really taught me and led me by the hand to where we are today.
Wow. So we were talking earlier and I was actually surprised that y'all told me something that I didn't realize. So we've worked with self-directed companies before. Definitely understand the frustration and struggle sometimes with lack of communication, the time it takes to turn the funds around from your regular account into the self-directed account. And you guys had said that basically there's a way to stay compliant and avoid doing that. So for the listeners out there that might already have a self-directed account or understand what a self-directed account is, and they're thinking about transitioning some of those 401k funds or maybe some funds that's, in their regular IRA, explain the difference, because not a lot of people know, the custodian route and, what's involved with that versus the services that you guys advise and offer.
Yeah. So, early on when the custodians were not really, were making my clients mad at me, normally if I refer somebody somewhere and they come back pissed off, like, I don't want to keep doing that. I'm like, oh, I gotta figure something out better and trying to make my clients happy. And at first I thought, well, I just need to create a good custodian company. And, what I found out eventually really is that, no custodian is ever going to be as good as no custodian. And what I mean by that is you kind of have like 3 stages to doing like a real estate deal with retirement funds. Number one, which probably most real estate investors are going to be familiar with, is kind of setting up the structure, right? So if you're doing your first real estate deal, I mean, maybe you're going to set up like an LLC. So, people are used to that. Then there is the actual doing of the deal, so the transaction. And then with retirement accounts, you also have the annual reporting. And so ultimately, I think what most people are familiar with is setting up the structure with the custodian, doing the transaction with the custodian, and doing the annual reporting with the custodian. And most of the frustration relates to the transaction, like, hey, when are you going to wire my funds? Hey, when are you going to sign that contract? Hey, I'm going to lose this deal if you don't sign the contract by Friday.
Yeah.
And I'm paying this per diem interest. I mean, I had this one friend of mine, he ended up owing like over $15,000 in per diem interest because he was in a deal that needed to go through the custodian, and he was having a hard time getting a hold of them, getting them to act on his behalf. So the thing is that when you set up a structure, that's pretty straightforward. Like with us, we set up the structure usually same day. Then with the transaction, that's where all the friction, the delays, the errors can occur, the money wired to the wrong closing table, et cetera, et cetera, et cetera. And the reason that happens is because the custodian is being an intermediary. They're being like the middleman between you and the transaction actually occurring. And in the intermediary, they got this big old pile of laws called ERISA, where they can get into trouble in 99 ways, depending on if they make a mistake. So they're very risk averse. And so unfortunately, what ends up happening is you have like an administrative employee that is probably not an expert in real estate, probably never even done a real estate deal. And they're just following some checklist very slowly. And then by the time it all gets done, usually the investor goes, I don't ever want to do that again. And our way of doing things, we set up the structure same day. You go do the transaction the same way you normally do the transaction. And at the end of the year, the annual reporting is taken care of either by us or your CPA. So it ends up being about as straightforward and easy as you're already doing real estate deals. But because of the way that we set up the structure, you're able to get the tax benefits of having all of your gains and all of your income deferred in taxes or even tax-free in the case of Roth. And we do that with our 2 different types of structures. Our most popular is the solo 401k, and then there's the checkbook IRA.
Okay, so I want to get to those 2 in a second. So just to summarize there, you've got it set up in a way where it basically removes that custodian from the actual transaction itself and allows the user to basically be in charge of wiring the funds or more or less controlling that transaction, all while still staying compliant. Do I have that right?
Exactly. The wiring of the funds and the signing of the contracts and the signing of the HUD and everything, all the documents. What's happened is, if there's a custodian, in some cases there is, some cases there's not, they're in the background. The transaction doesn't really involve them.
Then why do my transactions take so long with these self-directed companies? Why? What is going on? Explain that one to me.
you probably don't want to pay a huge fee. So now they're not going to hire some super high level legal expert. And yet they're still subject to this big old pile of laws that can get them in trouble. So, it's just kind of something where if you're paying somebody to do something really well, then, you're going to have to pay a lot. And people don't like to pay a lot. So what you end up with is kind of just it all balancing out for the fees to be reasonable. They're not able to move very quickly.
It takes them a long time to sort through the jargon and the compliancy before they do it, basically.
And what's also happening, Brandon, is you're in line, right? You're in line behind the other investors in front of you that are trying to get their transactions done as well. Whereas when you have the checkbook control, you're the first person in line. So you get to decide when to send those funds.
Okay. So
they also happen to use some software that might not have changed a lot in the last 20 years, where our expectations of how we're going to do a real estate deal has.
They're still using floppy disks. I knew it. I knew what it was.
And not even the little one. You remember the big one that was extra floppy? That's what they got.
That's what they've got. Well, that explains it. That's good to know because I'm over here getting frustrated, and now I can understand what's going on behind the curtains to cause some of that. So you just mentioned two items. One was a checkbook IRA, and forgive me, I forgot the first one. You said it was solo 401k. Is that right?
Yeah.
Now,
Exactly.
for those listening that don't know what a solo 401k is, can you explain what that is and who qualifies?
Yeah, solo 401k is a special type of 401k plan designed specifically for solopreneurs or entrepreneurs who have no full-time employees other than themselves and their spouse.
And you can't have any employees, right? So would a workaround around this, because I've got lots of employees, but if I had an LLC that owned another LLC and I was the only member of that LLC, say my S Corp owns 5 or 6 different LLCs and it basically owns it, but that specific S Corp or whatever entity doesn't have employees, does that count or there's some kind of special exclusions?
Usually that counts. Some sorts of ways of kind of trying to find a workaround can work, but most ways don't. In that case, we would probably steer you towards a checkbook IRA.
Mhm.
And it's essentially full-time W-2 employees. So if you have like independent contractors don't count as employees.
Yeah.
If you have a partner that owns a piece of the business, or if you have an equity options program where some of your employees, if anybody owns any of the company, they technically become an owner employee, which is a legally separate concept from a employee.
Got it. So you can have a business partner. So like if my S Corp or LLC or whatever, again, just to get rid of all the jargon, if I've got an entity that owns my construction company has 7 employees, right? They're all W-2, but it's owned by my mother LLC that doesn't have any employees. Does that still count? Is that a good workaround, even if I've got a partner in there? Or I'm curious
Potentially, it would
because
be a question of your ownership percentage in the business that has the employees.
okay,
The cutoff from the IRS that if you own 80% or more, they're going to lump those in as one business. They call that a controlled group. But if you own 75% of that business that has employees and you've got a business partner in the mix, then that means your other entities are in the clear that you own wholly.
okay. So for my so if I own 100% of my S Corp and it owns the company that owns, I guess, pays the employees, then because I own more than 80% of that, then it's kind of like,
No, actually, it's that you can own 100% of the holding company, the S Corp. It's that then if the S Corp owns under 80% of the business that has non-owner W-2 employees, then you're probably okay. Obviously talk to an attorney.
Yeah.
But if your S Corp owns 80% or more, then you wouldn't be able to do the solo 401k. And, for most people, there's a really easy way to get an answer of if I qualify. You can just go to solo401k.com/qualify. And it takes about 30 seconds to click a couple of buttons, and then you get an instant answer 99% of the time right there.
Okay, thanks for clarifying. So in my case, that would work because I've got a partner in the construction company. I don't own 80% of it. So
Perfect.
technically that would work. And this would I could just, use my S Corp and all.
There you go. So you don't
the
even need a workaround. It just happens to be that you already qualify. Because in the grand scheme of things, what the IRS sees is people with business A that they own 100% of, and then business B that they own 100% of. And they're like, they lump them together because what they don't want is they don't want people creating some new fake business just to try to get around the rules on the other business or whatever. But that's not what you've done here, unless you did it secretly before we started the podcast. But it sounds to me like you already set things up the way that you want them, and they happen to work for a solo 401k.
Well, that's a huge benefit. And for those listening, tell us a little bit more about the solo 401k structure. I mean, this is really powerful because I think a lot of people all look at, Roth IRAs and regular IRAs, and they look, I can only contribute $6,000 per year, tax-free. It's going to take me forever to keep paying into that and building up a sizable critical mass that actually does something. So, why do it to begin with? But I don't think that's the case with solo 401ks, right? Is the contribution limit different?
Yeah, so there's a few. So first off, self-directed IRAs are very powerful. Solo 401ks, our general rule of thumb is if you qualify and you're investing in real estate and alternative assets and almost anything really, you should do the solo 401k if you qualify, because everything that self-directed IRAs generally can do, solo 401ks can do. And then there are some multiple specific advantages. One multiple specific advantage is the contribution limits are 10 times higher. So, you can only, what's the limit for an IRA this year?
$6,500.
What's the limit for a solo 401k this year?
$73,500.
Wow.
So they're literally, I don't mean that figuratively, they're literally 10 times higher. And a good resource is to go to solo401k.com/calculator. And you can just see what your contribution is. And that contribution could be tax deductible. It could also be Roth. And it's really your choice, which brings me to the second major advantage, is that a solo 401k can really be like 4 IRAs in one. Because on the IRA realm, if you have a traditional pre-tax IRA where you get a deduction, and if you have also a Roth IRA where you forego the deduction for all the gains to be tax-free, and then if you have a spouse who has their own traditional and their own Roth, all 4 of those, you have the power to do all 4 of those inside a solo 401k. A solo 401k is a retirement plan where you can actually have multiple sub-accounts. So you can do Roth and pre-tax in the same plan. And you can have your spouse participate as well. The other big advantage for real estate relates to the use of debt or mortgage financing as leverage. If you do that within an IRA, you now must have a Form 990T prepared by your accountant, and you must pay taxes on the portion of your cash flow or your capital gains that are attributable to the leverage. So if you took a 70% LTV loan, then basically like 70% of your cash flow, of your income, and 70% of your gains are going to be taxable. Not necessarily a deal killer. You definitely have to do an analysis on a deal by deal basis, but you're completely exempt from that concept with a solo 401k.
Wow. So you mentioned bundling a few of the other Roths, self-directed IRA, you might have said HSA, I can't quite remember, into your 401k. How does that work? Are you still able to say the max contribution is $70,000 a year? And for those listening, basically, if you fall into this category where, you don't have any employees, or you've got a business that's structured kind of what we've just talked about earlier, if you net $100,000 per year taxable, you can put 70,000 and some change into it and reduce your taxable liability down to $30,000. I mean, that's huge. That's a game changer, especially when you're trying to prevent clips to your portfolio from taxes, because tax is the number one thing that prevents these portfolios growth. So that is huge right there. Are you saying that you're on top of this, you can still also contribute the $6,500 per year to a Roth, or the $6,500 a year to an HSA or the other taxable accounts as well? And like, how does that work inside the solo 401k? Because I was thinking they were kind of separate, but maybe I've got this wrong.
I'll answer part of that, and Rachel, I'll hand it back to you for the other part. But first of all, there is a bit of a calculation. For example, if you net $100,000 a year profit from your self-employment activity, you are going to end up being able to put about 40,000 of that into the solo 401k. So it's basically like the first about 20,000 that you make can just be 100%.
Dollar for dollar.
Dollar for dollar. You just put it right into your solo 401k. Beyond that 20,000-ish mark, you can put either 20 or 25% of your earnings. And I'll tell you kind of the key to understanding this superpower is that, when you have a 401k at some big corporation, they're going to do matching, right? And, some financial planners would be like, oh, matching, it's like free money, always contribute up to the match. But like matching is like, they'll maybe match 3% of what you put in or something like that. But the key concept is with it, when you're working in a big company, you're contributing as an employee, and then the company is contributing as the employer. With a solo 401k, because you are the employee and the employer, you're going to contribute as an employee, and that runs by the same rules as if you were working in a big corporation.
Mm-hmm.
Where the self-employment kicks in as a big advantage is when you come back around and contribute as an employer, you're not being cheap and trying to only put in 3%.
Yeah.
You're basically going, what will the law let me do? Because I'm the employee and the employer. With the solo structure, it enables you to do the maximum by law, which is 20 to 25% of a profit sharing contribution. And that goes up to a total maximum of
66, yeah,
was
or
it
73.
66 or 73, depending on if you're over or under 50, right? So now that is just you. If your spouse participates in the business and the solo 401k, he or she can do another up to 66,000. So actually you can end up putting away, like if you make maybe about 180 or so, or you and your spouse make up to about 180 each, then you can be putting away, and like I say, you're over 50, you can be putting away around 130, 140,000 per year. And so what you start to see is this kind of like 40-year path to retirement that used to be the way we thought about things that didn't work out for most people. By the time they got to the end of the rainbow, the pot of gold wasn't there. Like you can actually condense down this path, not only by pursuing extraordinary returns through real estate, but by just accelerating the entire path and condensing it down to like a, 7, 10, 12-year path to legitimate retirement where you can actually like get your cheese before they move it.
So I want to make sure I understand this. You said now 50, you mentioned the age being 50 plus. What nuances come with being 50 versus being under 50?
It's called a catch-up contribution. So the IRS basically recognized that by the time someone's in their 50s, they oftentimes don't have as much as they were hoping to have. And so they just give anyone who's over age 50 an extra boost of like, hey, you can contribute an extra, what is it, 6,500, 6,000?
Yep.
Okay.
Yeah.
I see.
And they have this with IRAs as well, right? If you have a normal IRA, you can put in 6,500 every year. If you're age 50 or older, you can put in an extra $1,000 to your IRA. That's the IRA version of the catch up. It's just a lot tinier than a solo 401k.
Okay. And now I see. So after 50, they give you a chance to kind of catch it up a little bit. And so just to make sure I got this right, it's a percentage. It's not like a cap, like with the Roth or the like the regular IRAs where it's a max of $6,500. It's up to, I think you said like 66, 70, somewhere around there as a percentage of your income, like somewhere around 20 to 25%. So to be able to contribute that, $65,000, $70,000, you'd have to be making somewhere in the ballpark of, like 200, 250, something like that. Do I have that right?
Exactly. The more you earn, the more you can contribute. And I was actually just talking to one of our clients the other day. He's a luxury realtor here in Scottsdale, Arizona, and he brings in about $350 a year. He takes $250,000 for himself. He pays $100,000 to his wife. She helps him with the books and doing bookings and stagings and stuff like that. They have an S corp together. So he issues himself a W-2 every year for $250,000, and he issues his wife a W-2 for $100,000. Based on his earnings, he's able to put in the full $66,000. Now, he wants to get a little bit of tax deferred growth. He wants a little Roth. So he tends to put in his employee contribution, that first $22,500, right into his Roth. But the remainder, that extra $40,000 to get him to that 66K max, he does that as the employer profit sharing contribution. So remember when Jeff was talking about it's kind of like having 4 accounts in one? That's his pre-tax and his Roth. But remember I said he also pays his wife a W-2 of $100K a year. She does the same thing where she puts $22,500 into her Roth, and she fills up the remaining $25,000 into her pre-tax. So his pre-tax is being funded, his Roth 401k is being funded, her pre-tax 401k is being funded, her Roth 401k is being funded, and they're putting away like $100,000 every year.
And he gets a $46,000 tax deduction where that amount of money is literally removed out of his taxable income before he even needs to go start deducting his home office or any of the other stuff that is usually peanuts compared to his tax deductible contribution.
And to blow your mind even more, like I said, he's a luxury realtor in Scottsdale. So what does he know? Real estate. Well, he and his wife turn around and they use some of the money that they put into their 401k and they invest those 401k funds into what they know. They buy real estate deals, and all of that income then grows tax deferred or tax free.
Oh, wow. So he's getting the write-off through hiring his wife. That's a write-off to the business. And she's basically able to just funnel some of that money into her retirement account. I'm gonna have to go hire my wife tomorrow and execute this strategy right here.
Exactly. Exactly.
Yeah, for
I
real.
see
You
how
gotta
it works
figure
now.
out what kind of work we were already doing and what else could you do? Because actually, even if you go into that case, this is how they were already doing things. But like next year around, when we sit down with them, we're going to point out like, hey, if you, instead of going was it 250 that he paid? Instead of going
250.
Instead of going like 250 and 100, like if you guys split that down the middle and 350 divided by 2, and you then paid yourselves 175,000, then you could actually both put in 61,000. So then you'd be 61 plus 61. You could put in 122 between the two of you instead of just the 66 plus, what was
44 she gets to do.
44. Yeah, so you could actually squeeze another $10,000 of contribution out there. It sounds small until you realize, well, you couldn't even contributed that much into an IRA, let alone the other 110,000. So it's a real unfair advantage. If you take two people who know real estate about the same, but one of them uses a solo 401k as a wealth building tool, they can go do the same deals. The guy with a solo 401k will retire way sooner.
Yeah, 100%, because he's able to put more in there and it grows tax-free. He's able to get the
And part of
snowball
what you're
going.
putting in is money that would have gone to the IRS. So it's almost like the IRS is coming to the table and contributing back some of your own money into your own deal. So there's the tax advantage of just getting money in there, and then the tax advantage of it growing either deferred or tax-free.
Yeah, that is absolutely huge. I want to get to a couple gold nuggets that you guys sent over that had my curiosity. So on here, I know you guys had talked about a strategy you guys use on basically how to legally avoid 1031 and capital gains taxes in your real estate portfolio. I mean, tell us more about that.
That's really all about just kind of shifting your perspective, because a lot of people, they end up with these kind of limiting beliefs. Like one limiting belief is doing deals in your IRA or using your retirement funds for real estate. It's either not worth it because of the hassle of the custodian. Well, we take that away, like you need the checkbook control. Or a lot of times people will go, oh, but I don't want to give up my tax deduction. And, in other words, I already understand the model of how to do this with my taxable funds. And so there's a lot of people that kind of have some limiting beliefs around the model of how to do it within retirement funds. And, 1031s can be very powerful. I'm a big fan of 1031s, but even the 1031 and even the solo 401k or the checkbook IRA, these are all just tools, right? These are all just like players in a game. But the way that you win the game is by putting points on the board and winning the game. So you can use a 1031, but just going like 1031 for life, nothing else, that's going to be pretty limiting. And even just going like solo 401k for life, nothing. If you just pick one tool and you only use that one tool, then there are going to be times where it's like going really well for you. There's going to be times where the tool works against you, just like you're not going to build a house using one tool. So, the area where 1031s can be limiting is if you are getting out of a deal that's at a certain part of the market cycle. Let's say you're selling a property and you've really figured it out. It's the tippy top of the market. The 1031 forces you to then buy at the tippy top of the market too. And there are things you can do to try to overcome that. You can go, well, maybe it's the tippy top in Nashville, but maybe it's a totally different market cycle in Memphis, or maybe it's totally different market cycle in Jacksonville or something. And you can go to another area, but there's only so much you can do with that. I mean, generally speaking, the Federal Reserve, whether it's expanding the money supply or contracting the money supply, kind of affects all markets in a similar way, where when you kind of switch your mindset to understand that 1031 is only one tax strategy, but utilizing in the first place to acquire the property in a retirement account means that when you go to sell the property, you can sell the property and you can sit on cash for 5 years, or you can take that particular pile of money and you can go, you know what, I'm getting out of single family and into multifamily, or you can say, I'm getting out of real estate and into Bitcoin, or whatever you want to do. You can shuffle your asset classes around, and essentially it's just going to be tax deferred or tax free, no matter what it is. Whereas 1031 is like, well, it's got to be like kind, and you've got to do it with, you've got to identify your property, then 45 days, et cetera. That can sometimes force you into, not being able to take advantage of market cycles or different kinds of assets at different times.
Yeah. So you basically, just to kind of summarize this, you've got two vehicles. One is the solo 401k, putting up to, that 73,000, 500 per year into that, building an egg where you can actually then go and buy real estate. And the other is just using your cash. If you're using your cash, you're buying the real estate, boom, you want to sell it, you time the market, you want to 1031 it. Well, now you're forced. You only have a very limited amount of time to go find another deal to put that in. It's got to find a home. Otherwise, you're going to take the tax hit on it, and you're forced, right? So you can't really take advantage of the market cycle if you're just using your cash vehicle. Whereas if you're using your solo 401k vehicle and you've done the exact same deal, you've timed the market and you've sold it, now, because it's owned by your solo and 401k, your retirement account, you can transfer it to cash, which is what will happen, but you're not taxed on it because it has that tax shelter status that the IRS gives us. And so you're able to kind of wait it out, or just let it sit in cash, or transfer it into stocks, or whatever you want to do. Did I get that right?
Yeah. You could sell in a seller's market and then hang out and wait for the buyer's market to come back to you as a buyer. And that's going to usually take longer than 45 days.
Love it. The other nuance that piqued my curiosity, you guys said that there's a way to get like a $50,000 line of credit to invest in real estate. Can you tell us a little bit more about that?
Yeah.
Absolutely. So the solo 401k has a really special benefit to it that's called a participant loan. And what you're allowed to do is you can take a tax-free loan, tax and penalty free, of 50% of what you've got in your 401k, up to 50 grand. And you can use those funds for any purpose. So if you have a property that you want to buy with cash, but maybe you need a little bit extra capital to get there, you can take the loan from your own 401k. But the real magic is there's no middleman that's collecting that interest on the loan. It's your 401k that's receiving 100% of the loan principal and interest repayments. So it's like getting a little extra bump into your 401k that's, again, growing tax deferred or tax free.
Oh, wow.
Yeah,
So
you're paying the interest to your future self.
Yeah, you're just able to take out a loan for, I said, half the amount up to $50,000 max out there. Well, I'm going to do that and just put like a 10,000% interest payment or something on there.
Yeah,
there's a little bit of rules about that. There's a little bit of rules.
Yeah, you do have to. So the law basically says that it needs to be just like 1% over prime. So you can't just choose the interest rate. But the cool thing is you can do it for any purpose. You can do it any time. You can repay it over a 5-year period. And because it's a participant loan, if your spouse participates, you're one participant and your spouse is another participant. So using it together is actually a way where you could get instant tax-free access to $100,000 cash. You just have to keep in mind that you got to be paying a payment back, and you got to factor that into your personal finances. But yeah, you could absolutely use that $100,000 to do a real estate deal taxably. Now, why that's important is because when you look at doing a deal outside of your retirement account or inside of your retirement account, there's no right or wrong way to do a deal. There's just a strategy of the deal. And one thing you have to bake into your strategy is that when you're doing a deal with taxable funds, you can go get a lot of financing as leverage if you want it. When you do a deal inside your retirement account, you cannot pledge your personal guarantee. You can only get what's called a non-recourse loan. And non-recourse lenders will usually require like a 30 or maybe even 40% down payment. So if you've got a deal where you're gonna put 50% down, or you're just gonna do the whole thing with no financing, that can be pretty compatible for doing inside your retirement account. Conversely, if you have a deal where it's like, I really need to be able to get like a 10% down financing, well, you can't do that with non-recourse lending. So if you're all tapped out of cash to do it with your other taxable money, you can take that 50, or with your spouse, $100,000 money, loan it into being taxable, and then use that as, like, say, your $100,000 down on $1 million property.
That's huge. That's huge. This is some great information, you guys. This really is generational wealth, expediting compound interest, and it's little known strategies not many people know about. Jeff, Rachel, it has been a pleasure having you guys on. If the audience wants to learn more about solo 401ks or connect with you guys about your services, how do they do that?
Probably the best thing is just to go to solo401k.com. Again, there's the /calculator. You can get to the calculator /qualify, gets you to the qualification quiz. And you can also use a little chat window on the bottom right. And during business hours, our team is there available for you. As soon as you have signed up for a solo 401k or just reach out to us in any way, you can get on our email list there too, because we send out notifications for when we're doing webinars, and we can have live Q&A sessions. And this really helps people to kind of put together their strategy, right? I like what you said about that generational wealth plan. I think we really give people the ability to rethink their strategy and like cut decades off of it. And we like to be part of that process and kind of workshop through it on webinars that we do about every month or so as well.
We will make sure that all those links get posted below in the description. It has been an absolute pleasure. Thank you guys for coming on today.
Thank you.
Likewise.